What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 31st of 2020. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to spend some time to talk about a very important concept, and that's not only understanding the concept of inflation, but along with that as well, velocity, and talking about why the Fed is downplaying the rate of inflation and the cost of living for everyday people, and how in the near future it could get much, much worse. So, we're going to be talking about this as we go throughout the video, and why I believe Bitcoin is not only the solution to hedge against that inflation, but along with that as well, we've got a sponsored review for Sologenic towards the end of the video. So I recommend you stay tuned for that. You won't want to miss it. All right. So let's go ahead and talk about this concept, guys. At its base core, I want to go ahead and get a few pieces of language out there for those of you who may not know about. So there's a few key terms that we want to know about here. For inflation, if there are those you may not know, I think the majority of you probably know about inflation if you're into Bitcoin or gold, but if you don't, it's no worries. Inflation is the increase in the base monetary supply. So if I, for example, know that there are $1 trillion out there in the economy in this case that are in existence, right? We can know that each of those dollars has some form of purchasing power if we so give it purchasing power. If people are using it day to day for exchange of goods and services, then in this case, we can kind of start to determine how much an apple should be worth, or how much a car should be worth, or how much a home should be worth, right? And there's another term we're going to be talking about, which is velocity. And we'll dive into that a little bit later on in the video. But this base concept of inflation is very important to understand, because if inflation gets too high, usually we tend to see it reflected in price. And that's usually what you hear when people talk about the CPI or the Consumer Price Index, or when people talk about inflated housing prices or inflated costs for healthcare or education. Things just start to get ridiculously expensive. And it's usually due to the fact that there's an increase in the monetary supply. There's more dollars out there in the world, right? So we'll come back here to Bitcoin in a bit, but I think it starts really well here. I think this kind of whole topic really starts well with this article here that came out from Bloomberg just yesterday, or sorry, 2 days ago, where the Fed had its FOMC meeting, its Federal Open Market Committee meeting, when they do from time to time, and they basically discuss their changes in monetary policy. So the Fed really manages two things here. They manage either the printing, right, of new money, or lack thereof, or they change interest rates, which is basically, in this case, the Fed funds rate for the most part, which is the rate that it costs for a lender to borrow capital from another lender under collateralized. So this basically is in order for banks to borrow money from one another and basically borrow money to produce new loans, or to provide credit in some shape or form, or put money somewhere else, right? So we have these two things the Fed has been balancing. And as Powell tends to always hit, as many Fed chairmen have hit in the past, they've stressed the need to hit 2% inflation. This is supposedly the sweet spot that the Fed always aims for. And they're basically looking for 2% annually in the CPI, the Consumer Price Index, which is a basket of representation of the cost of everyday living for people across the United States. Now, the interesting thing here, if we dive into this article, right, they've decided to not change monetary policy. They've already been doing what's known as easing in this case. They've been reducing interest rates, so it's cheaper to borrow capital. And along with that as well, we'll see that the Fed has been adding on to its balance sheet here. It's actually been reversing what's known as quantitative tightening, and has been continuing back on its course of expansion that it started back in 2008 since the recession. So we're adding more cash into the system, right? We're taking in more, the Fed's taking in more treasuries and more toxic assets like mortgage-backed securities, right? They're taking in a lot of those assets and giving in new cash to the financial sector. And as we mentioned again, after continuing on for a more than a 40-year trend here from the 1980s, we have seen the Fed's fund rate, again, continuing to drop back down, even though we hung near zero for the last, it wasn't specifically the last 6 or 7 years, but over 6 or 7 years. If we take a look back here from 2009 over here to 2015, all right? So we're reversing this course after just finally getting out of that period where we were at 0% interest rates. Well, in an environment where you have 0% interest rates, where capital is practically abundant and free and nearly risk-free in this case, right? It's basically, you just have to make sure you're not going to lose money in this case, right? If you could get a 2 or 3% yield on your money, it would be worth borrowing through the effective Fed's fund rate these last few years. And along with that as well, even still here, so long as you're making more than 1.5%, right? And not to mention as well, the mass injection of money in the economy How is the CPI below 2% on an annual basis, right? You have to ask yourself. That's a very fair question. And quite frankly, it's two reasons. One, the Fed is lying to you because the CPI is not a decent measure of actual consumer prices and real world inflation. And second off, we have to understand a concept known as velocity. So we'll talk about these one step at a time. So there's a really good website, and actually I had a fan actually share it with me. It was something that kind of came new to me, and I've been looking for something like this forever because I've known that the Fed has manipulated the CPI. They've changed and adjusted the CPI for a long period of time, taking in certain types of items or indexes for prices to keep that rate artificially low in this case. But there's a really interesting index called the Chaplet Index. And you guys can go through, it's a free website. Just look up chapletindex.com and you can actually go through and read through how the index actually works. But like the CPI, it's supposed to measure a cost of everyday living and the increase in cost, or maybe the decrease in some cases, but we have not seen that in a very long time, in everyday living. And the cool thing about the CPI, it's comparative to the CPI here, the Chaplet Index takes in a basket of a whole ton of stuff. Some things that would be included in the CPI that do play a role in everyday living, but also things that the CPI doesn't factor in. And you can just see here, it's a whole basket of different assets here. Some things that are, kind of knick-knack items all the way to big ticket expenses. We can see here big things like health insurance, cost of a mortgage, cost of your rent, to small things like everyday items, for example, like bottled water, French fries, a gym membership, right? So you have all kinds of different items here that the index is basketing. But not just that, we actually get to go a little bit deeper, and we can see on a per city basis where the Chaplet Index is fluctuating in this case, how much interest, or sorry, not so much how much interest, how much of inflation or cost increase are we seeing between these different cities and on different years. We can see here from 2015 to 2016 to 2017 to 2018, we can see a range of anywhere from around 7 to 13% in some of these cities, with a 5-year average over here on the right, where again, we still see that rate here between anywhere from 7 to 13%. Now, there's some variations here. Sometimes prices can rise because there is supply and demand, right? There is an increase in demand in the economy. For example, mortgages or rent might go up in certain cities because, hell, there's a lot of people who want to move to that city, right? A lot of people want to live in New York City or LA, or a lot of people want to live in Boston or San Francisco because there's economic opportunity there, right? But taking this into mind here, right, we can see here that no matter what city you look at, you can take the bare minimum here where you see some cities with an average of around 7 or 8%. Right? I think the lowest here is Tulsa and Wichita. Sorry. Don't trust me with pronunciations, guys. Let me stick to the finance and economics. Anyways, basically talking about this in the sense of the cost here, right? We have to really think to ourselves, the CPI first off is lying, right? The CPI is not giving us a real reflection of cost. When you start to take a broader index of everyday items, but also the big ticket expenses, we start to see that the CPI is not giving us a fair reading. But I can tell you all that this is really only the beginning. I think you all feel this. When you go to the store and you see the prices of meats or everyday goods that you're buying going up, it surely doesn't feel like 2%. When it sometimes feels like you're just getting by in some cases. And it feels like even if you're getting a pay raise over the last year or two, it's barely keeping up with expenses. Because it's not just the CPI in this case, it's really the Chaplet Index. The Chaplet Index is showing us the real cost, where on an annual basis, we can see prices rise anywhere from 10 to 11% between your rent, from your insurance, from your mortgages, your cost for goods and services that you're buying every single day. It's going up. But there is something even worse to fear in this case, and that is the concept of velocity. So there is a difference between inflation and velocity. Inflation is the base increase in the monetary supply, and that can happen when the Fed prints money. It can happen through how commercial banks have, again, built on top of that monetary supply through credit, and that's through the form of fractional reserve lending, where they don't have to have a full account of reserves for the amount of credit that they have in circulation. So people could think that they have $1,000 in the bank vault, when in reality, the bank only has $10 allocated for them, which would be a 1% reserve ratio for fractional reserve lending. But again, concept for another time. Long story short, there could be a lot of new money created. But velocity is a different concept. Velocity is how frequent that dollar or credit is circulated through the economy on a basis of time. So if a dollar is circulating more often, then in this case velocity is increasing. If a dollar is sitting in a vault somewhere and not doing anything, then there's no velocity in that money. And there's a good example here that they mentioned here in this article. This was written back in 2010, but it's a very good point here. Here's another slightly weird example to illustrate the point. So they said in the example, let's say that the Fed just decided for whatever reason, hypothetically, to print $1 trillion and give it to Bill Gates. And Bill Gates promised that if he took that $1 trillion and put it in like a no-interest savings account and promised not to move it for the next decade, well, there's been no velocity there. There's been inflation, right? There's been a printing of money, but there hasn't been velocity. And velocity is what can lead inflation to amplify in this case. When there is a creation of new money, it can be reflected in this case if the monetary supply over time, it's well-known knowledge that the base monetary supply has increased, and therefore prices can increase. And some of that, to be fair, has gone into the economy. Some of it has. But a lot of it's gone into the bigger ticket expenses, which is why the CPI doesn't reflect it comparative to the Chaplet Index, which includes mortgages, which includes rent, which includes a lot of the big ticket, longer term expenses like healthcare and education. For example, educational loans in this case, or student loans, nearing $2 trillion in debt. Again, that's where a lot of the credit's gone, right? So we can see that if we make a broader example here, we can see that some of that inflation that has gone into the economy for the bigger ticket expenses or into asset markets like properties, that's where we see the cost coming in, the increased cost for individuals. But going back to this topic of velocity without losing, getting sidetracked here. Now that we understand velocity, where's velocity at right now? That's the important question. Well, for the M2 money supply, which has been increasing, in fact, since back here in January of 2008, right, as we stepped into the recession, we have actually doubled the base monetary supply, more than doubled the base monetary supply. So in around about a decade, right, we've doubled the amount of money in circulation. We'd obviously expect to see some pretty high levels of velocity in this case, right? Well, actually we haven't. Since back here in 2008, we've actually seen velocity go from about 1.9 down to 1.4. So over a certain basis of time, we're seeing a dollar change hands instead of 1.9 times down to 1.4. So what does this tell us? I mean, we have to really think about it here. What does this tell us about where the money's flowing? That's a very important question to ask. If it's not going into the hands of everyday people who spend pretty much every dollar they have, and they spend so much that they're probably taking out credit or debt to spend even more, then where's the money going? Well, the money's going into asset markets. The Federal Reserve over the last, I'd like to say that it's only been a decade, but if we really go back over the last few decades, has been building a massive asset bubble. And they have not supposedly learned from their mistakes. I think they know exactly what they're doing. But they have yet to actually get to the core understanding of why they keep building this asset bubble. It's because they keep printing funny money and they keep lowering interest rates, right? So as the Fed has done this, right, as there has been a lack of velocity in everyday dollars being spent in the real world economy, we have seen a mass amount of money not only just flow directly into equity markets, right? We just talked about the repo market, for example, the other day, where banks, the interbank rate, where banks are lending to one another overnight, a lot of that money has actually not been lent out to banks for commercial loans for you and I. No, it's going to hedge funds who are speculating and taking excessive margin-based positions, basically borrowing capital to have to basically take on exponential risk in positions, but also have exponential potential rewards. We've also seen that money, as it's gone through the economy here, has flown into corporate earnings. And also, as we've had regulatory frameworks that have allowed for companies to engage in stock buybacks, where they take cash that they get from earnings or borrowed capital that they take on, basically through the form of credit, they take out a corporate loan. They are going through and buying back their own shares, the shares that they own themselves. And they're also paying mass dividends out. So they're not only earning great dividends on the shares that they own, but also it's attracting more capital to, rather than being lent out to everyday people, to be going into equity markets, right? And the bottom half of America does not own practically any assets. 0.5% of all assets is owned by the bottom half of America. The other top half of America owns 99.5%. So you can guess who's faring well in this system, who's able to possibly hedge a little bit against inflation. Certainly not the bottom half of this country. And I can tell you, even if, I'm not just trying to play games here, guys, with the numbers. If you take it up to 75 or 80 or 90%, most people are barely keeping up with inflation. You have to be in the top 5, 10% to be keeping above inflation and possibly doing better than where you were back in 2008. And it has a lot to do with this system. The Fed has built an asset bubble. It's not focused on trying to lower the cost of everyday goods for you and I. It's put the priority in this case of lower interest rates and printing of new money and taking on those toxic assets from the financial system to keep the same rampant speculation going, because they know at the moment that they pull back any of those levers as they were doing before, if they continue to rise interest rates and they continue, they pull back the printing of money, it is going to burst this bubble. You are going to see stock buybacks go down. You're going to see dividends go down. You are going to see the overall asset bubble, this 30 to 40 trillion dollar market. And this is just U.S. equities, plus the property market, go down, where those costs are going to go down for stocks, but also for properties and rent. And what's going to happen is you're going to see velocity increase. You're going to see just how much money was stocked up, right? There will be initial decline, but when this velocity picks up, this money's circulating and people start spending it again, this newly found wealth, what you're going to see is you're going to see the prices of a lot of goods and services start to go way up, even past what the Chaplet Index is showing us right now. Because all that money was locked away. As we talked about with the example of Bill Gates, it wasn't in the real economy. It was in money markets. It was in treasuries. It was in equities or properties. And we didn't see it on everyday goods and services, right? So this is the key thing to take in mind here, guys. Velocity is key here. The Fed knows what it's doing. If it understands the concept of velocity, which it does, because quite frankly, I got its velocity chart off of the Fed website. So this is the Fed Research Economic Data website. So, I mean, come on, guys. This is very important to take into mind here. It's a very important concept to understand. And now we have to talk about, how do we hedge it? Well, I think Bitcoin's where we hedge it, right? There's not only the growth potential of a new emerging asset class like cryptocurrencies, but Bitcoin having a finite supply hedges, in this case, across the board with rising costs, with the printing of new money, with the, again, all this capital that's going to come flowing out of equity markets and possibly out of property markets. It needs a place to go. And I'm not saying that this is basically meaning that this makes Bitcoin more valuable. I'm saying that Bitcoin hedges because there's a limited supply, right? And if people want to go ahead and hedge against the depreciation of the currency as more enters into circulation, that inflation starts to turn into velocity, Bitcoin is a hedge. Where if I own one Bitcoin, I know I have 1 in 21 million Bitcoin. It doesn't matter how many dollars they're printing, right? Because that's what we're comparing to. This price here is a ratio between Bitcoin to dollars. So that's the very important thing here. As velocity increases, Bitcoin's price will likely increase if it serves as that hedge. That being said, everyone, I've rambled on enough for today. I hope you all enjoyed this topic that we discussed. That all being said, though, let's go ahead and dive into our sponsored review of Sologenic. Alrighty, everyone, so let's go ahead and spend some time to take a look at today's sponsor, and it is no other than Sologenic. Now, some of you may recall the name because a little while ago we did an interview with an individual known as Bob Ross, who is not only one of the co-founders of CoinField, a prominent exchange based out of the EU, but also one of the co-founders of Sologenic. And Sologenic, to put it simple, is basically aiming to bridge the gap between traditional world assets like stocks and ETFs, which we discussed about here on the channel, with the emerging asset class of digital assets such as cryptocurrencies, and making sure that there's a liquid bridge where you're able to gain exposure to either different asset class or multiple different asset classes at the same time, and not have to go through the cumbersome traditional ways that you would in the financial world, where you'd have to withdraw at your exchange and spend days, if not weeks, trying to go between platforms. So it's a really big concept, and I think what's really cool about it is they're aiming to do it in a decentralized way. So we'll talk a little bit about the tech, the team, and how they're aiming to do this as we go throughout the video. Now, there's one thing I want to note here before we dive into that, and that's just understanding, quality of experience. You can have a great vision, I think, with any product, but it's important to understand whether or not the team has delivered on previous projects in the past. And I have to say, in the case of CoinField, guys, they check off a lot of boxes. In the case of CoinField, as I mentioned, it's a prominent and well-regulated EU exchange in the cryptocurrency space. They are regulated by the Finance Intelligence Unit in the EU and also have direct banking partnerships as well. They've got over 200,000 users, $20 million in daily volume, so a nice organic number of volume here, nothing absorbent, but at the same time, nothing small, so you can make liquid trades. And then along with that as well, they've been able to provide a variety of different currency pairs ever since launching back in 2018. So it's pretty cool here. Less than 2 years being around here, CoinField has had a pretty good success story. Now, they're not just an exchange, right? They do have a great advanced trading system here. So you can see they've got a ticker symbol up at the top, just showing some of the different pairs they have. You can go through and browse a variety of different pairs. They have pairs against XRP, USD, some stable coins as well, Canadian dollars, European dollars, the Great British Pound, the Japanese yen. So you have a lot of different fiat pairs to work with. You have a lot of different altcoins, and you have all the tools that you need here on the general kind of advanced exchange, right? You can see not only the percentage change here over the last 24 hours, you have a trading view chart, but you've also got previous trades being made, the order book, the depth chart, everything you really need in a trading platform. And I think they've done a really good job. This is why I think they've been able to pull in an average rate of about $20 million in daily volume, because they have a nice functioning exchange here. They stick with the trading view API. I love the design of trading view. You can get real-time price data on not only the order book here, but also on the actual direct price. But this isn't the only thing that they've done through CoinField as well. They've worked much more as well towards servicing retail users like yourself and myself, who, again, at the end of the day, might want something that's more simple. So they also have a CoinField wallet that you can download on both iOS and Android. And you can see here that they've got a lot of good features here. So much like the exchange, you have a lot of sense of security and transparency in the sense that they're using BitGo security. So this is kind of the industry grade, top-notch level of custodianship that's offered, that's streamlined and white labeled by a lot of different exchanges and platforms. Along with that as well, you have transparency. So with all deposits and withdrawals, you can track your cryptocurrency funds because it's all settled on chain. And along with that as well, they have server isolation. So to kind of dive into this again, I wouldn't be able to dive into the intrinsics of this because, like with any exchange, they keep a lot of this stuff proprietary or basically under the scenes. But the major thing that they do is they have a lot of different backend systems with the private servers that make sure that, again, there's extra layers of security when securing your funds, securing activities in your account to make sure that no one's going to compromise it, right? Or if someone were to directly attack a CoinField server. So these are all great practices to have. Now, along with that as well, again, you can get price alerts, you can favorite your certain markets that you like. User experience looks extremely clean. This is how crypto wallets and exchange wallets should look, plain and simple. It shouldn't be any more complex than this because it doesn't need to be more complex. So again, you guys can check this out if you want to just go ahead and test some of their existing products here to see how they're able to deliver. I think they've got some great products here. I love the user experience on them. But I want to go ahead here and talk a little bit about Sologenic now. I mean, we understand here that Barras and the rest of the team actually know how to deliver a real product that gets real volume and real users and does it in a regulatory fashion. In this case, they do things by the books. Now, this vision of Sologenic is pretty ambitious. It's one that I think is easily achievable, but at the same time, I think is really going to be a game changer in a lot of ways because a big issue for most people stepping into cryptocurrencies that I've seen from a lot of people who even have access to crypto markets is that for those who are actively trading or manipulating their positions between traditional world assets and crypto, they don't have an easy bridge to do so. So for example, if I was using two traditional platforms like Coinbase or Robinhood, the issue I'm going to have is that if I wanted to trade maybe an altcoin that I have access to on Coinbase, but I might not have it on Robinhood, and maybe I, for example, want to take that altcoin position that I have on Coinbase and sell it and convert over to a stock position. The difficulty is it's going to take multiple days. The fees are probably going to be pretty exorbitant, and it's the biggest difficulty there is time. In that case, going between those platforms, I shouldn't have to do that. It brings too much complexity, and I don't have liquid access. Not to mention, I'm not doing it in a decentralized way, which again is kind of against the ethos of cryptocurrencies. We want to pursue a decentralized opportunity to be able to do this. So this is where Sologenic comes in, right? So right now, there's the existing projects of the centralized exchange, the iOS and Android app. There's the fiat and crypto wallet. This is again integrated directly into the centralized exchange in this case, and they also offer OTC services. But this is what basically Sologenic is aiming to achieve. Now, let's go ahead and talk about some basic technicals, right? This is a clean one-pager here if you guys want to read a little bit, dive a little bit deeper. They also have the official white paper. Now, of course, we probably won't have all the time to go through that throughout this video, but to just go ahead and talk about these basics here. Again, as we talked about the general concept, they're building this bridge between equity markets, like such as ETFs and stocks, over into cryptocurrency assets. And I think they have an ambition to move into even more assets, but they're going to be able to trade over 30,000 assets, if I got it correctly. I think it was around 30,000 they're going to have at launch, which is going to be pretty exciting. And it's all powered through the XRP ledger. Now, again, this is really interesting here. The XRP ledger system, from what I've seen so far, has not really had any big projects built on top of it. I haven't seen people really utilizing the kind of fast transaction speed and the basically distributed network of banks that make up the XRP ledger. And this is actually kind of cool to see something being built on XRP. Again, I've been keeping up with XRP for some time. It's a project that, again, I think is something that meets them in the middle between an absolutely decentralized system like Ethereum, which can still have some time delay in order to get transactions. It can take a couple of seconds to sometimes a minute, depending on the gas fee that you pay, and also is usually generally a little bit more expensive than an XRP transaction. In this case, Sologenic has obviously opted in for convenience. They've opted in for a system that, again, is made up of consensus nodes that are well-regulated, well-known players in the banking sector that can easily process these transactions very quickly and serve as that very quick and liquid bridge to trade in and out of different assets. So again, this is very interesting, I think, in this case, to experiment with that and test out the XRP ledger system. So there's a few key things to talk about here, right? So this expands on CoinField's vision, but outside of this as well, I mean, this really brings about a lot of different opportunities. It not only gives me the opportunity to go in and out of crypto assets to equities, but also just have from one place a balanced portfolio from different asset classes in one single basic solution, in this case, based on the XRP ledger. So I can not only hold basically a token on the network that's pegged to maybe Tesla stock, but I could also own ownership in something that basically tracks the price of Bitcoin or Ethereum in this case, and I can have price exposure to both ends. Now, it's important to note as well, there are really kind of two coins and tokens in this case. So when we're talking about tokens, we're usually talking about the securitized assets in this case, right? The Tesla stock, the ETF that might give us a broad exposure to tech stocks or to the healthcare sector. Whereas in the case of the coin on the network, there's the Solo coin. And if you guys actually register, you guys can actually get a few coins for free. A lot of exchanges tend to do this and stuff. You'll be able to get some Solo coins that you can utilize for trading. So it's a good benefit in that case if you actually want to save up some. But there's a lot of other products that they're offering here through Sologenic. When they launch, they're going to be able to not only offer the decentralized ledger in this case, where you can do the decentralized exchange on the XRP ledger, but you'll also be able to get crypto cards in this case. So we've seen a lot of debit cards kind of enter into the crypto space, but we haven't seen a lot that come with a really nice lineup of benefits here. And Sologenic has a pretty nice little stream here. So there's different tiers, and it depends on how much Solo you hold up. Again, we've seen this before, this model where you basically stake a certain amount of coins and you can get a certain tier of card. And there's these 4 different tiers here. So the first benefit in this case is the liquidity provider reward program. And this basically, because you're staking Solo in this case, you're going to be able to get rewards for this in this case. So again, like proof of stake, how you get a yield, it's generally the same kind of picture here when it comes to the liquidity provider program, where you can get up to 20% annually in this case in rewards. So again, from my understanding, you're getting paid in Solo in this case, but again, 20% is a pretty good yield. If the exchange and the platform and the ecosystem is getting more adoption, then in that case, you might likely, you could see the value of the coin go up, could go down again. Something to keep in mind. Another thing as well is the monthly rebate. So you get about 2% back on every purchase in the form of Solo coins. So it's kind of like, again, basically almost like a reward program in this case, where I'm going to shop, I'm spending from my Solo card, and I get 2% basically cash back in the form of Solo, in this case, Solo coins. And the third one here is trading fee discounts. So similar to some exchanges where if you use this utility token of the Solo coin, in this case, you're able to get discounts, but up to 50% is pretty nice. It's very lucrative in the case of trading. So I would say that these 3 benefits here are really nice. If you're an active crypto trader, if you're someone who's actively participating in the market, I'd say that these benefits come quite nicely. If you're already going to be staking or utilizing Solo as a utility token and trading it, these benefits can help carry the value of it a little bit further. Now, again, as we talk about here, right, we've already seen CoinField produce a great product. The vision here for Sologenic, I think, is very fascinating as well. But a vision and a product are only as good as the team. And I got to say here, it's nice to see a lot of the CoinField team, who again have already proven themselves in building a great product, coming over here. And just like with CoinField, Sologenic is taking things one step at a time, and they're making sure to do things in a regulatory and compliant nature, which is so imperative for doing something unique like this, where you're bridging between traditional assets and moving into the cryptocurrency space, and just tokenizing these different assets in this case. It's very important. So, of course, we have Bob Ross here, who is, again, not only the CEO, but also the co-founder of Sologenic, and then also CoinField. And you have Reza as well, who is also one of the other co-founders of the project. But they also have people in certain areas here, right? They have EU Securities legal advisor Virgin Niel, in this case, who is basically helping to guide in this case that, we're trading securities here, right? There's the utility token, which is the Solo token. But when you're trading these tokens in this case, or you have the Solo coin, but if you're trading any kind of tokens that are pegged to a value of a stock like Tesla or Apple, that's a security at the end of the day. So they have to make sure that they're complying with those laws. The nice thing is they've got all the proper banking partnerships and the licenses to actually do this, which is really exciting. And you've also got team members, again, who are working in the banking industry. I know, for example, Iman here, I've actually met him. He runs some of the largest conferences out of Malta. They have someone directly from XRP, basically XRPL or XRP Ledger Labs, who is helping them probably to build out these systems and integrate it onto the XRP Ledger. And you also have people who are core focused on blockchain compliance with AML, anti-money laundering, and again, all kinds of different individuals working in marketing and legal. So I think this is really nice to see a nice formed team here of good 12 members here to really kind of deliver on the Sologenic vision. Hopefully they'll be adding more as time progresses. But all in all, I really like the vision here, guys. I think that something like Sologenic could be really valuable because I've had this problem myself. As you all know, I'm a macro trader myself. I don't like to just trade one asset class. I'm definitely probably more exposed to crypto than anything. But even if it's just 20 or 30% of my portfolio, or up to sometimes more normal levels for most people, like 50 to 60%, that might be in other assets like equities or ETFs. They give a more broader and low risk exposure in many cases. To have to go between different platforms, it's so archaic, and it shows that there's a key problem, as there are many problems in the financial sector that is yet to be solved, that Sologenic is trying to fix. And not to mention as well, providing a broader access in this case for individuals to get access to these different types of assets, I think it's not only going to be extremely healthy, but it's awesome. It's exactly the vision, what I like to see. And the fact that they're doing it in a decentralized way makes me even more excited. Now, the other thing that I think is really fascinating as well is the mission behind Sologenic. I think Bob, in this case, as well as many of the team, have come to the conclusion that it's best to try to pursue this in a decentralized way. But in doing so, we actually get a lot of transparency out of it. So this is one of the key things here, having a proof of solvency in this case, where you could track real time on the ledger your balance of any given position. A lot of this while having asset security, using industry leading ways of security to be able to make sure that funds are safe and secure throughout the system on Sologenic. And along with that as well, compliance. Again, guys, there are so many cryptocurrency companies that don't go through and take these necessary steps, and it's definitely imperative in this case, even for decentralized platforms, to have some form of compliance here. It's going to make sure that Sologenic can safely operate over the next coming years and decades. So again, I think that it's good that they're doing these steps. Again, I like to see that they're regulatory compliant. Along with that as well, they're big on transparency, proving solvency in the exchange, and also doing it all in a decentralized fashion. So I think that that's very valuable too. So kind of general thesis here. I like the vision. I can't wait to see Sologenic come out. And again, if you guys are interested, again, they're giving away a little bit of Solo coin for free to anyone who signs up. So we'll have a link down below in the description where you can get those free Solo coins. And again, if you have any questions, feel free to reach out to them. We'll also leave a lot of the social community channels for you guys to contact the team, contact people who are working not only on Sologenic, maybe some people as well on the CoinField team, and you can get a better idea of what they're building if you have any extra additional questions. And again, as I always recommend, read through the white paper. Dive in a little bit deeper if you're interested in it like myself. But that's going to be it for the video, guys. Thank you all so much for watching, and I'll see you all in the next one. Stay tuned.